So what exactly happened here? Well, Trump was supposed to let these massive tariffs kick in on July the 11th. We're talking tariffs as high as 70% on certain countries. Instead, he gave everyone 3 more weeks to figure out the trade deals. Now, on that Monday, his administration sent letters to 14 countries basically saying this: here's what your tariff rates are going to be if we can't make a deal. Now, most of these rates were similar to what that they had talked about and announced back in April, but they're saying that they're open to negotiations. But here's the thing, and this is really important for us as investors. Tariffs are different from other scary headlines. When there's wars in the Middle East, floods in Texas, wildfires in California, those are terrible events, but they don't usually hit corporate earnings directly. Tariffs, on the other hand, they absolutely can crush corporate earnings. And corporate earnings are what drive stock prices, which what drives your 401k balance. That's why back in April, when Trump first announced these tariffs, the markets went crazy. They got hammered. Then when he announced the pause, stocks bounced back. This past week, the market's reaction has been really pretty muted, which tells investors that maybe, just maybe, the final tariff rates won't be as brutal as they were when they were originally announced. Let me put this into perspective for you. If these tariffs actually do go into effect at 70%, here's what could happen to companies that are in your retirement portfolio. First, supply chains get all messed up. Think about companies like Apple. They make iPhones in China. Walmart sources tons of products from overseas, and Home Depot imports building materials from all over the world. Higher tariffs mean higher costs for these companies. Number 2, profit margins are going to get squeezed a great deal. When it costs more to make or to import products, but you can't immediately raise the prices on consumers, your profits are going to suffer. And then third, cost eventually get passed on to consumers, and that hits you and that hits me. That slows down the economic growth because people buy less stuff when everything costs more. And then fourth, all of this creates inflation pressure, which affects everything from your grocery bill to what the Federal Reserve does with interest rates, which means higher loan prices, higher credit card interest rates, higher mortgage rates. Now, here's something interesting from some research that I've been looking at from Fidelity. Market volatility has come down a lot since April. The VIX, which is an index they use to chart it, that's the fear gauge for stocks. It dropped from around 60 back in April to about 20 right now. But that could change in a heartbeat if negotiations fall apart. Let me walk you through where things actually stand with major trading partners, because the situation has changed a lot in the past week.